You reach a point in life where the pressures hit from both sides. You're raising kids who need your attention, and you're caring for aging parents. The demands are simultaneously pulling you in opposite directions, leaving you entirely overwhelmed by everyone else's timeline. Look at the actual numbers for the average 45-year-old. The median retirement account balance sits right around $45,000. At current cost of living trajectories, that leaves a significant gap between current savings and the capital required to sustain a 30-year retirement. Then the math really sets in. You wake up and realize you only have 10 to 15 years left before you hit traditional retirement age. The runway is shrinking. The advice to just invest $50 a month and wait 40 years is no longer a viable path. That strategy requires decades of slow compounding to work, and for a 45-year-old, those decades have already passed. A 20-year-old can take massive risks because they have time to recover. An 80-year-old prioritizes capital preservation. But in the middle, you are trapped in a strategic vacuum. You don't have the time to weather a 10-year market correction, yet you don't have enough capital to rely solely on low-yield cash reserves. This vacuum forces a shift in your financial logic. Managing your remaining time becomes the single most crucial factor in how you prioritize your remaining earning years. With a shrinking timeline, you have to undergo a psychological shift. You must abandon the instinct to use speculative assets as a way to catch up on missed years. It is tempting to look at high-profile tech IPOs and charismatic billionaires as a shortcut. People see the hype and think a single lucky trade will compensate for a decade of low savings. But the data tells a different story. If you buy into a highly publicized IPO during its first 90 days on the public market, you are entering a period of peak volatility. Historically, these stocks often see a significant price correction after the initial excitement fades, which can wipe out the capital you need for the final stretch. Contrast that risk with the track record of boring businesses and standard index funds. While they don't make headlines, they provide a level of statistical consistency that speculative individual stocks cannot match over a 15-year period. This chart shows how wealth accumulates over time. Notice the long, flat period of slow growth at the beginning. But once you hit a specific numerical threshold, typically around $100,000, the compounding interest transitions from a linear crawl into an aggressive upward climb. If you are in your 40s, you are sitting right here, at the elbow of this curve. You are positioned to capture the most vertical growth of the entire compounding cycle, provided you don't reset the clock with a speculative loss. To capture this growth, you have to ignore the noise. Success in this phase comes from moving away from individual stock picking and relying on the historical averages of the broader market. Your 40s and 50s are your peak earning years. This is the period where you must move from simply managing expenses to ruthlessly optimizing the utility of every dollar you earn. When you receive a higher salary, the priority shifts to upgrading specific appreciating assets. Simultaneously, you need to audit your recurring expenses, removing the automated subscriptions that slowly erode your investment capacity over 15 years. This chart illustrates the tax choice for peak earners. A traditional 401k offers an immediate tax deduction today, which is valuable when you are in your highest tax bracket. A Roth 401k, however, requires you to pay those high taxes now in exchange for tax-free withdrawals later. As we animate these figures forward 15 years, notice the tipping point. While the traditional 401k saved 37% initially, the Roth 401k saves you 100% of taxes on the growth. Because your contributions are compounding so aggressively at this stage, the tax-free growth often results in a higher net payout than the original tax deduction. Then there is the psychological burden of debt. At 45, you have to distinguish between low-interest mortgage debt and high-interest consumer debt. For the latter, using the avalanche method, paying off the highest interest rates first, is the fastest way to free up cash for your investments. This strategy also favors a 30-year mortgage over a 15-year term. By extending the timeline, you lower your mandatory monthly payment, which provides the liquidity needed to maximize your market contributions during these high-growth years. By combining these tax optimizations with consistent liquidity, you build a financial structure that can withstand unexpected shocks without derailing your retirement timeline. As you enter your late 50s, the objective shifts. You are moving away from the phase of accumulation and into the phase of aggressive preservation. This brings us to the final major decision in your timeline: when to initiate your Social Security benefits. This break-even chart compares the lifetime payouts of claiming Social Security at age 62 versus age 70. While claiming early provides immediate cash, waiting until 70 results in an 8% increase in benefits for every year you delay. This crossover point shows that if you live past age 80, the delayed start provides a significantly higher total lifetime payout. The emotional desire to exit the workforce early must be balanced against these figures. To secure the capital you've built, you must establish estate planning that accounts for these long-term payout variances. This also involves evaluating insurance. Term life insurance provides high coverage for a fixed period at a low cost, which is ideal if you have a specific debt or dependent timeline. Whole life insurance is more permanent, but comes with higher costs. Choosing the right one determines how much of your final estate is actually passed on to your heirs. Mastering this time-sensitive approach is about more than just meeting a retirement date. It provides a repeatable method for any generation to maintain and transfer capital across decades.